Two people, same $50,000. 20 years later, one of them made a mistake that cost them hundreds of hours of their life, and neither one knows it. You've seen the debate. Real estate builds generational wealth. Index funds are passive income. Your neighbor just bought his first rental property. Your friend at work won't stop talking about his Vanguard account. And somewhere between those two conversations, you're still trying to figure out who's actually right. Here's what I'm going to show you today. Almost every version of this comparison you've seen is missing at least 3 costs that change the final number entirely. So we're going to run the real math, all 20 years of it, including the parts the real estate influencers conveniently skip. And by the end, you're not just going to know which strategy wins on paper. You're going to understand what that answer actually means for the next 2 decades of your life. Let's meet our 2 players. Ryan has $50,000 saved. He earns $55,000 a year. He's been watching real estate content for months, and he's ready. He puts his full $50,000 as a 20% down payment on a $250,000 rental property. 30-year mortgage at 7% interest. Monthly payment, $1,330. He finds a tenant willing to pay $1,800 a month. On paper, $470 a month in profit. Ryan sits at his kitchen table, does the math, and thinks, I figured it out. Andre also has $50,000. Same salary, same age, same city, same financial starting point. But Andre puts his $50,000 into a broad index fund and sets up an automatic $300 contribution every month. Then he basically forgets about it. His coworkers ask what he's investing in. He says index funds. They nod politely and change the subject. Nobody's impressed. Ryan drives past his rental property on the way to work and thinks, I own that. That's mine. Andre logs into his brokerage app once a quarter, sees a number that's slightly bigger, and closes the app. Here's the thing nobody told Ryan about that $470 in monthly profit. It doesn't exist. Not after property taxes, which run about $3,000 a year. Not after insurance, another $1,500 annually. And not after the day-to-day reality of owning a structure that houses a human being. In year 1, Ryan replaces a water heater, $1,200. He didn't budget for it, but the water heater didn't ask. By year 2, a leaking roof, $2,800. Month 14, right as he's starting to feel confident, his tenant moves out without much notice. That's $1,800 in lost rent for 1 month, plus $600 to clean and relist the unit. By the end of year 3, Ryan has collected $64,800 in rent. His mortgage payments total $47,880. On a napkin, that looks like $16,920 in gross cash flow. But after property taxes, insurance, both repair bills, and that 1 vacancy month, his actual net cash flow for 3 years is somewhere between $2,000 and $4,000. 3 years. 40-plus months of being a landlord. And after every real expense, he has maybe $3,000. That isn't passive income. That's a second job with unpredictable hours that pays less than babysitting. Meanwhile, Andre, who answered 0 phone calls at 10 p.m. and made 0 trips to a hardware store, has put in $50,000 upfront plus $10,800 in monthly contributions over 3 years. At a 10% average annual return, his portfolio sits at about $76,000. He did nothing. He waited. Now, before you permanently close your real estate investing app, wait. Because Ryan has something Andre genuinely doesn't. Something real, something powerful, and something that almost no investment vehicle in the world can replicate. He has equity, and he has leverage. That $250,000 property has appreciated roughly 3 to 4% a year. By year 3, it's worth somewhere between $270,000 and $280,000. After the principal Ryan's paid down on his mortgage, his equity has grown to roughly $55,000 to $65,000. He used $50,000 to control $250,000 in assets. That is 5-to-1 leverage, and it is the one genuine advantage in this entire comparison that index fund investing simply cannot replicate. So after 3 years, Ryan holds equity around $60,000. Andre holds a portfolio around $76,000. It looks close. It looks like real estate is holding its own. But there's a cost in Ryan's ledger that nobody is counting, and it's the cost that quietly destroys this comparison. Capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These aren't surprises. They are scheduled obligations. The property's future owner will always pay them. The standard rule is to budget 1 to 2% of the property's value per year for maintenance. On a $250,000 house, that's $2,500 to $5,000 annually. And these expenses don't arrive as small, manageable invoices. They come as chunks of $5,000 to $15,000, like a $7,000 HVAC replacement in August when your tenant is texting you that it's 95 degrees inside and they're not renewing if this isn't fixed today. You didn't budget for that. It doesn't care. By year 7, Ryan has replaced the roof for $8,500. A plumbing emergency cost $1,400. He's raised rent to $1,950, which helps. But his actual cash-on-cash return, the money he pockets relative to the money he's put in, is hovering around 3 to 5% after all real expenses, not the 15 to 20% return he casually mentioned at his last dinner party. Andre at year 7 has done nothing except watch his portfolio grow from $50,000 to roughly $135,000 to $150,000. Andre is now ahead. How? This is compounding. What Warren Buffett once called the 8th wonder of the world. It's boring for the first 5 years and almost frightening for the next 15. Once Andre's portfolio crosses $100,000, each year's 10% return generates $10,000 in growth without him adding a single dollar. By year 10, the annual returns are bigger than his original contribution. The machine is feeding itself faster than he can manually add to it. Ryan at year 10. His property is worth roughly $335,000 to $350,000. Remaining mortgage balance? About $166,000. Equity? Approximately $170,000 to $184,000. Total out-of-pocket beyond the down payment, repairs, CapEx, vacancies, somewhere between $20,000 and $35,000. Real money spent to generate that equity, $70,000 to $85,000 over a decade. Andre at year 10. Portfolio approximately $165,000 to $180,000. Total invested? $50,000 upfront plus $36,000 in contributions. $86,000 all in. 0 repairs. 0 emergencies. They're essentially tied. Wildly different paths. Radically different effort. Now here's the 20-year verdict, the number that makes this real. Ryan's property is worth roughly $450,000 to $500,000. After paying down the mortgage over 20 years, his equity sits somewhere between $400,000 and $500,000. His total net cash flow over 20 years, every dollar collected minus every dollar spent, might produce $40,000 to $80,000 in actual profit above his costs. Ryan's total wealth from this single decision, approximately $450,000 to $580,000. Andre's portfolio has grown to approximately $420,000 to $460,000. Here's the number that reframes everything. Of that total, Andre contributed only $122,000 over 20 years. The other $300,000 plus is pure compounding. He put in $122,000 and got back $420,000. And if he'd increased his monthly contribution by just $200 a month, $200, his portfolio would have jumped to roughly $550,000 to $600,000. 20 years. 2 nearly identical wealth outcomes. One path required managing tenants, roofs, furnaces, plumbing emergencies, vacancy periods, and a jurisdiction with specific landlord-tenant laws. The other required logging into an app once a quarter. Before you decide Andre is obviously the winner, stop. Because I haven't told you the part that should genuinely unsettle you about index funds. In 2008, the market dropped roughly 37%. In March of 2020, it dropped 34% in a single month. If Andre had $150,000 in his portfolio and watched it fall to $95,000 in a matter of weeks, that is not a number on a screen. That is gut-wrenching. Most investors sell at the bottom. Most people cannot sit on their hands and watch half their net worth disappear without doing something. The index fund strategy only works if you are psychologically capable of watching your portfolio crater and doing absolutely nothing. Ryan's rental property didn't lose 34% in March 2020. His tenant kept paying rent. And there's no meaningful cash flow from index funds. Not really. Andre might earn a 1.5 to 2% dividend yield. On a $150,000 portfolio, that's about $200 a month. Ryan's cash flow, even after expenses, grows meaningfully over 20 years as rents rise and the mortgage stays fixed. By year 15, Ryan's monthly income is real and substantial in a way Andre's dividends simply aren't. So when does real estate actually beat the math? 3 scenarios where the numbers genuinely flip. House hacking. If you live in one unit of a multi-unit property and rent out the others, you eliminate your largest expense, housing, while simultaneously building equity. The math doesn't just work, it becomes a completely different equation. You're not comparing investment returns anymore. You're comparing paying rent every month versus having tenants pay your mortgage while you build wealth in your sleep. The 0.8 to 1% rent-to-price rule. If monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor. On a $250,000 property, that means charging $2,000 to $2,500 a month. In many expensive markets, that's impossible. In many mid-tier and secondary markets, it's achievable. Know your specific market before you buy, not after. 1,031 exchanges and depreciation. Real estate has legitimate tax tools that index funds cannot match. A 1,031 exchange lets you defer capital gains taxes indefinitely by rolling profits into a new property. Depreciation lets you deduct the theoretical decline in your building's value from your taxable income, even if the property is actually appreciating in the real market. For investors who use these tools systematically over decades, the tax-adjusted returns tilt the comparison significantly toward real estate. Here's what 20 years of this math actually proves. Real estate and index funds can produce remarkably similar total wealth outcomes. The difference isn't the final number. It's what you paid to get there. Dollars, yes, but also time. Decisions, emergencies, weekends. The phone calls at 10 p.m., the HVAC in August. You're not choosing between 2 investments. You're choosing how you want to pay for your returns. The people who win with real estate are the ones who genuinely want to manage properties, who find markets where the rent-to-price math works, who use leverage and tax advantages deliberately, and who don't count the hours as costs because they find the work interesting. The people who win with index funds are the ones who can automate and disappear, who trust math more than they need to see something physical that they own. The worst financial decision isn't choosing one over the other. It's choosing either one because someone made it sound frictionless, without running every number, including the ones they didn't show you. If you just realized that the real enemy in this equation isn't real estate or index funds, but the specific psychological traps that make us terrible at both, I made a video on exactly that. It might be the most important one on this channel right now. It's on screen. And if this changed how you see this debate, which side were you on before you clicked? Leave it in the comments. I read every single one.